Starting with above the line tax deductions, there is a tax deduction that's going to be available for seniors up to $4,000 if they make $75,000 or less as a single tax filer, $150,000 or less as someone married filing jointly. And the goal of this is to eliminate or diminish the impact of taxes on Social Security benefits. This has been a big emphasis of the Trump administration. To have an understanding of what that means and why it's important, we need to talk about Social Security benefits briefly. We have not done so on this podcast to this point. In the near future, we're going to have an episode strictly dedicated to Social Security. But for today, I want you to understand that when it comes to the benefits that you earn, up to 85% of your Social Security benefits can be taxable depending on if you make above a certain amount of money. Note, I am not saying that 85% tax is applied to your Social Security. I'm saying that, for example, it's not how much you're going to get, but let's say that you got $100,000 of Social Security benefits. If you earn a certain amount of money, when it comes to the income on which you pay taxes, they can choose to use up to $85,000 of it in this example to count it as taxable income, and the remaining $15,000 would not be taxed. Now, that tax on Social Security benefits is something that they're trying to do away with. So rather than actually doing away with the fact that it's taxable, they're instead offering you the ability to just reduce the amount of income on which you pay taxes. And the hope is that they'll be able to kind of have it balance out. That's the intention of it. So this is something that phases out for income earners above those levels of 75,000 or 150,000. But that's something that you may need to be aware of if this bill passes the Senate in the same form. Next up is an above the line tax deduction for the interest that you pay on certain car loans. And this was one that I had to do some reading up on my own because it was a little confusing at first read. But let's say, for example, that you have a car loan where you pay $5,000 a year for that car loan, and you find out at the end of the year that half of that, $2,500, was interest instead of you actually paying down the principal. Well, this tax deduction is saying that that $2,500 in interest could be used to reduce the income on which you pay taxes, which sounds at the surface level as a pretty cool concept, right? Cars are costing more and more money. If you have a loan that has a lot of money in interest and you get the tax deduction, then hey, that's potentially a good deal. There are a lot of caveats, however. Some of those caveats is first that it is income based. So it starts to phase out your ability to take that deduction if you are earning more than $100,000 as a single tax filer or $200,000 as a joint filer. There is a limitation to up to $10,000 of car loan interest. That would be a whole lot of interest on a car loan on a yearly basis, but there's a limitation on that of up to $10,000. You also only have this deduction available for the next 4 years. If it's not extended beyond that point, then this isn't something that you can just do going on ad infinitum. And then lastly, you only can be eligible for this if the car's final assembly occurs in the US. So this is not even something that's available for all cars, even if you do fit within those income limitations. So this is something that, again, it speaks to some of their objectives about American made and all that. But between the final assembly in the US, the phase out based on high income earners and all of this, it's unlikely that a tremendous amount of people are going to be able to use this deduction, but it's something of which you need to be made aware. And another element of this bill that's an above the line tax deduction is the tax deduction for people who earn income via tips or through overtime pay. So first, you have to be in a profession where earning tips is an expected part of your profession. So for example, maybe a barber or a waiter. And what they're doing is they're saying, hey, if you total up your income, and let's say as a waiter, you made $50,000 for the year, and it turns out that $10,000 of that was for tips, then you can have a $10,000 tax deduction where now you're only paying income on $40,000, effectively removing that tips income from your pay before you file taxes. Now, there are income thresholds for all of these things, especially when it comes to the deduction of overtime pay. So this was something that if there were no income limitations, that would be a huge benefit, especially if you're in a profession like a physician where you earn crazy money, but it's still tied to an hourly rate. You know, you're making $200, $250 an hour, but you may pick up a shift where they're paying you $300 an hour. It would be great if you could deduct that from your pay. Unfortunately, there is a limitation where you can only deduct your overtime pay if you are not an highly compensated employee. And the threshold for highly compensated for a single filer is you can't have a modified adjusted gross income of over $160,000. If you file married filing jointly, you can have a modified adjusted gross income of over $320,000, but that's actually a pretty high threshold. So if you are in that camp where you make $150,000 as a single filer, or you make $250,000 as a joint filer, but you have income that's considered overtime pay, this is a potentially big deal to actually keep track of those numbers. It is important to note, however, that even if you are eligible for the deduction on the tip income or the overtime pay, these also are only eligible for the next 4 years. And if not extended, this is a tax deduction, or these are tax deductions that would go away.